In this part of the video, I'll discuss my assumptions and conclusions about PanAmerican Silver. I'll also discuss more about potential entry points or where the price could bottom out. And in the next part of the video, I'll discuss the 2021 annual financial statements and third quarter financial results in more details with the discussions of some notes. So, positive free cash flow per share of 80 cents in 2023, that's just an assumption. In reality, in 2022, PanAmerican Silver is likely to generate zero or maybe even negative free cash flow per share. So the company needs to work out some of its problems in a couple of its mines, and hopefully, as it's promising, it's going to be done in by the end of 2022. But right now, it needs to invest more capital to resolve those problems and finally resolve those problems. Technical chart. Right after discussing these points, I'll move to the technical chart, but the bottom could be even at $15.5 level, depending on how you look at the chart. So unfortunately, there is a probability. However, unfortunately, based on the valuations, the price could still go down maybe 30 or 50%, but technically there is a chance for the bottom to form at $15.5. Another point, I didn't discuss fundamental factors for silver, but rising interest rates are potential negative for non-interest-bearing assets such as gold and silver. It becomes more expensive to hold these assets versus maybe some dividend carrying assets or interest carrying assets such as, for example, bonds. Next thing is, well, from the demand side, there is rapidly growing demand from the electrification industry, and electric vehicle industry and solar panels industry. So the demand is going to go. This demand is subsidized by the governments, and it's going to grow very, very fast. So simultaneously, when we look through the financial statements in the next section, you will see that the cost to produce silver is growing extremely fast, and it is very possible that some of the producers are going to be priced out, or some of the potential producers are not going to start mining silver just because it's becoming too expensive to do that. So on one hand, you have a lot of demand. On the other hand, the price is low enough that it is making unprofitable to mine silver. So at some point, something is going to break, and silver prices can just skyrocket. Returning to the technical chart, we can see again a long-term trend line that's been building for the past 20 years, and it is standing right now at about $8. Well, sorry to say that if you're long, but that would be a really safe place to buy if the price would get here. Then we have this support trend line, which has shown to be a good support level. It is standing at about $10.50, so that's also an interesting level to keep in mind. And then we also have potentially this support trend line, and we are standing right at it right now. So we could be at the bottom. Another indicator that we could be at the bottom is RSI. So whenever RSI reached these levels, it indicated that the price has mostly bottomed out, However, that was not exactly the case here. It bounced back, and then we stayed on our side lower in this range, and the price kept going down. But so we are somewhere very close to the bottom, or we are at the bottom. So first, let's look at the annual financial statements for the year ended December 31st, 2021 compared to December 31st, 2020. So we can see earnings per share. We can see adjusted earnings per share of roughly 77 cents or like 80 cents. The adjusted earnings per share removes some of the non-cash items and more descriptive of the real earnings that a mining company earns. So I'm just doing an assumption that the company earns about 80 cents a share, which equals to the PE ratio of 19.3. What is also interesting? Another important data is sustaining capital expenditures. It's roughly 200 million to 210 million. Then projected capital expenditures are about $15 million in 2021. Only $21 million in 2020. That was the COVID year, so obviously the amount was less. So we can see 34 cents in dividends per share. Then we can see the data. The data is the data for the real physical production. The data is heavily skewed because 2020 data was affected by the COVID, and so the production numbers were quite a bit less. Then another interesting data that I'm going to pay attention to is the cost per ounce of production. So in the silver segment, the cost per production on December 31st was $11.50. The overall cost, including all of the overheads costs, it was $15.6. So essentially that's the break-even cost. So if silver goes to $15.6, it for most of the silver miners it will make no sense to do any new developments. So this is quite an important data. Then same information for gold, $900 and $1,200 per ounce if you include the overhead. So let's move forward. Balance sheet. On the balance sheet, balance sheet looks super clean and very healthy. All I'm concerned with is the payment of dividends and the fact that the company can manage its debts and that it can manage its paying its debts and liabilities in case of a severe crisis, severe and prolonged crisis. I want some liability in the company that I invest my money into. So total long-term assets, short-term assets at $1 billion, long-term assets at $2.5 billion, short-term assets liabilities at $3.87 million compared to long-term compared to short-term assets of $1 billion. So very healthy. So company can easily manage its short-term liabilities with the short-term assets. So extremely healthy numbers. Then for the long term, here's the number for the long-term assets, while the total number of the long-term liabilities is just under $500 million. So essentially the company can cover just with its short-term assets all of its liabilities, short-term and long-term, and it will still have $2.5 billion in capital. So the company looks extremely healthy. Plus, it has unused credit lines that have $1 billion credit line that it can use anytime. So very healthy balance sheet. The most interesting statement over here is going to be the that's income statement, but the most interesting statement was going to be the cash flow statement. So on the income statement, while we see that their revenue grew, it was because prices of silver and gold grew. We can see net income. I'm interested in the net income per share. So it was 85 cents in 21, 46 cents in 85 cents in 2020, 46 cents in 21. The adjusted earnings were 80 cents a share in 2020 and 77 cents in 21. So I'm like going forward, I'm going to make assumptions that these earnings are going to stay the same. Although in 2022, when we do the review of 2022, we will see that the earnings in 2022 are going, both adjusted and non-adjusted earnings per share are going to go down quite substantially. Again, if we use these earnings and the current market price, we are going to arrive to the price earnings ratio of about 19. However, again, in 2022, the company is likely to generate very little income, if any. Let's move to the most important statement now, the statement of cash flow. So on the statement of cash flow, I am interested in the in calculating the free cash flow. So in 2021, we generated almost $400 million of operational cash flow from operating activities. Then, if you remember from earlier, we discussed cash spent on the sustaining expenses. That's very important. Without spending this money, the company is going to start losing the cash from operating activities. So it's an absolutely paramount expense for the company. So I'm going to use this. So I'm going to subtract the cash flow from the sustaining activities from the cash flow derived from the operating activities to receive cash flow, free cash flow. So our free cash flow is $182 million. The company uses roughly $50 million for its new projects, and is per year, and is paying about $70 million in dividends. So the company is awash in cash, at least in 2021, and was doing quite fine. It can manage its liabilities, it can manage payments of its dividends, and it can continue and develop its projects. So now let's move to the 2022 financial statements, where the story is going to change quite dramatically. So third quarter financial statements for PanAmerican Silver. On the third quarter financial statements for PanAmerican Silver, we can see that, first of all, the real production went down for both silver and gold. This was a result of some problems on a couple of mines. Then other important data, the cash cost. If you remember from 2021 video, the cash cost was around $11. Right now it is, during the third quarter of 2022, it went up to $14.62 for per ounce of silver, and $1,184 per for gold. The all-inclusive cost is almost $18 an ounce for silver and $1,600 for gold. So the costs have risen dramatically, which is going to affect a company's profit margin and obviously profit. So let's move forward and see how the financial statements were affected by these numbers. Simultaneously, we have to remember that during this time, for the past about 9 months, the prices of both gold and silver have been going down. So our costs have gone up, while price of the product that we sell has gone down. So balance sheet. Again, a balance sheet looks very healthy. Nothing to worry over here. nothing raises any questions. Long-term debt compared to December 31st, 2021 financial statements went down. Long-term debt compared to long-term non-current assets went down by 1% to 19% from 20%. So things look even better than 9 months ago, balance sheet wise. So again, no dangers here. We can also use the balance sheet to estimate the book value per share for PanAmerican Silver. So the current book value per share is $11.28, while the current market price is $15.45. So according to the book value, we overvalued by about 35%. It is interesting to mention that the book value is roughly equals to the intrinsic value that we've did in our calculations earlier. However, I do since the cost of development an ounce of silver and gold went up by roughly 30%, I would assume due to inflationary pressures, I would assume that the real book value is actually maybe 30 to maybe even 40% higher. So the current market price of $15.45 in reality probably equals to the real book value of the company. Real inflation adjusted book value. Let's move forward. So looking at the financial statements, so we see comparable 3 months financial statements and 9 months comparable financial statements. Over here, I would like to indicate then again, our cost of doing business went up dramatically, while prices of the product that we sell have been trending down. So this had to affect our profit margins. And yes, as we see, our gross margin has decreased almost more than 2 times since if you compare quarters, third quarters of 21 to third quarter of 2022. And same thing goes for the 9 months period for 2021 and 9 months period for 2022. So things look quite bad on the income statement. Then mine care and maintenance, it also indicates that it probably indicates that these numbers went up again due to the inflationary pressures. Impairment charges, note 8. This relates mostly to the Dolores mine impairment. Again, the cost of producing silver and gold went up, and so the operating this mine became at these prices became unprofitable. So the company recorded a non-cash charge of almost $100 million to reflect this fact that operating this mine is now an unprofitable business. And however, if we have to understand, if prices of silver do rise, operating this mine becomes profitable again, this charge is going to get reversed and the company is going to record the profit again. This is a non-cash item. So on the income statement for the quarter, the company had a loss of almost $100 million. For 9 months, a loss of almost $200 million. So things are not great, and far worse compared to, if you compare to the last year. So it's a difference of almost $300 million. So last year, for the 9 months of 2021, the company generated almost $100 million, or $80 million of income. Now it's losing $200 million. So the company generated 80 cents loss for 9 months of operations in 2022 versus 40 cents of income. If we adjust these earnings for non-cash items and other things, then we have an income of just 11 cents and for 9 months of 2022, and 58 cents versus 58 cents for 9 months of 2021. So things don't look very good, and actually moving forward, I wouldn't expect better results in the last fourth quarter of 2022, because if you look at the read through the financial statements more carefully, the company says that it needs to fix problems in a couple of its mines, and it'll take more money than it was initially expecting to fix these problems. So this is note 8 that discusses the impairment of Dolores mine. These are the pricing assumptions per at which points at which price ranges the mine is going to be more profitable. So if you go over $23 an ounce in the next year versus the company's assumptions, so the company will have to reverse the impairment charge. So that's not such a big deal in my opinion. Again, if you look at the cash flow statement, which is again the more important statement in my opinion, we will see again a quite bleak story. So for the 3 months ended September 30th, the company generated actually just 2.5 cents per share of free cash flow, and it is actually becoming cash flow negative overall because of all of its sustaining and other capital expenditures. However, again, if we return to the balance sheet, we have to understand that the company can weather these bad times, and again, we just need to wait for the price of silver to go up and the company to resolve some of the problems that it currently has in a couple of mines so that it can lower the production costs and increase the production levels. So for the 9 months, the company has generated, in just 9 months of 2022, the company generated minus 8 cents of free cash flow. So again, that's the reason that the stock price has been going down. The company is not generating any free cash flow. However, in my assumptions, I'm making an assumption that the company will improve this situation in 2022, as the company says in its financial statements. So almost zero free cash flow in the last quarter of 2022, not enough to pay the dividends. Otherwise, under normal conditions, the company should be able to generate about 100 million of free cash flow, more than enough to double the dividends. So we just need to wait and come to those normal conditions. Again, I'll repeat it again. If you look at my silver chart analysis in my other videos, there is a chance for silver to start going up, and so let's move forward, and we will just do some conclusions in the very end. In 2022 guidance, the management says management is revising its estimates for full year 2022 of silver production to be between 18 to 18.5 million ounces from 19 to 20.5 million ounces provided in 2022. The revision is largely due to lower production at Dolores and mines sequencing at La Colorada. So Dolores, as we've already discussed, there was an impairment charge at La Colorada the company needs to fix some problems that it expects to fix by the end of 2022, and that is why I'm making an assumption that when the company does fixes those problems, the production rises back to the normal levels. Plus, I expect the price of silver to stay maybe a little bit higher, so that the company can return to its 2021 profitability of roughly 80 cents of free cash flow per share in 2023. So so if you look at the current cost of production for silver, well, that's what the company is looking for. So for combined with all the overhead expenses, it's looking at the cost of production per ounce of $14.5 to $16. However, right now it is reporting cost of production of almost 18 cents a share. So we'll see if it manages to go to lower the cost of production. So something tells me that it won't be able to, but we'll see. Sustaining capital. Another negative thing going for 2023 is that the company is projecting to like an almost 20% increase in the use of the sustaining capital, so which is definitely going to affect the free cash flow, and it is going to affect the valuations. So in a way, I do believe that my 80 cents a share free cash flow assumption is good, but there is also a chance that it may not hold true. So let's move to the conclusions.